You have $100 million and the woman at the dry cleaner still calls you Han, and asks if you want extra starch in the collar. You say yes, thank you, same as always. You fold the receipt into your jacket pocket. You walk out. The bell above the door makes its small sound behind you. Nobody looks up. This is not an accident. The number didn't announce itself with a ceremony or a headline. It arrived the way all the important numbers have arrived, in a formatted document, in a plain font, on a Tuesday morning while you were eating cereal at a kitchen counter that needs rerouting. Your financial advisor, a measured and careful woman named Patricia who has been doing this work for 22 years and does not easily show surprise, wrote a single line at the bottom of the quarterly summary. Aggregate holdings, verified net, $101.3 million. You read it once. You ate the rest of the cereal. You put the bowl in the sink. That was 4 months ago. The architecture started with a storage facility. Not a glamorous entry point. Not a technology platform or a real estate syndication or a private equity fund with a 3-letter acronym. A storage facility. 48 units in a converted industrial building off a Tulane County road in southern Indiana, owned by a retired electrician named Harold who had been managing it from a folding chair in the front unit with a space heater and a ledger book from an office supply store. You found it the way you found most things in that period of your life. Not through a broker, not through a network, not through anyone who would have described themselves as a dealmaker. You found it because you needed a storage unit for 6 months while your apartment lease was ending and the new place wasn't ready, and when you drove out to look at the space, you noticed the lock on Unit 17 was broken and the gravel lot had standing water near the entrance from a drainage problem that looked like it had been there for years. You asked Harold about it. He shrugged and said he'd been meaning to get to it. You paid for your unit. You came back 2 weeks later and offered to buy the whole property. He laughed at first. Then he didn't. Then he called his daughter, who called a lawyer, who eventually called you back. The transaction took 11 weeks. You paid $310,000. Harold shook your hand twice and drove away in a pickup truck that needed a new muffler. The first year, the facility netted $44,000 after repairs, taxes, and management. You fixed the drainage issue in the first month for $2,800. You replaced the lock on Unit 17 for $18. The math was not spectacular. But the math was also not the point yet. What the math proved was simpler than anything anyone would put in a business school case study. People accumulate things they cannot get rid of and cannot keep in their living spaces. That need is not cyclical. It does not respond to interest rate environments. It does not pivot with consumer trends or evaporate when a new platform enters the market. A family going through a difficult transition needs somewhere to put the furniture from the house they can no longer afford. A small contractor needs somewhere to store equipment between jobs. A person in the middle of a complicated life needs somewhere to put the chapter they're not ready to close yet. The facility doesn't judge them. It just holds the things. It generates income every single month, whether you are present or not, whether the broader economy is expanding or contracting, whether anyone considers the transaction interesting. Nobody considers the transaction interesting. That, you came to understand, was a structural advantage. You bought a second facility 18 months later. Then a third. Then you stopped buying storage facilities, not because the model had stopped working, but because you had started paying attention to a different category of overlooked asset entirely. Self-service car washes. The ones in suburban strips near grocery stores and gas stations. The ones people pull into automatically, without decision, because the car is dirty and the machine is right there and the whole transaction takes 4 minutes and costs $9. The ones that run 24 hours a day without staff, without variable labor costs, without a manager who calls in short on a Friday night. You bought your first one from a partnership that was dissolving. 2 brothers who had stopped speaking to each other over something unrelated to the business. The asset itself was healthy. The problem was purely personal. You paid $480,000. The annual net was $71,000 the first full year you owned it. The second was distressed, genuinely. Equipment problems that previous ownership hadn't resolved. You bought it below market, spent $38,000 on equipment refurbishment, and watched the revenue normalize within 6 months once the machines worked the way they were supposed to. You now own 7 self-service car wash locations across 3 states. None of them has your name on it. The holding company is named after a county road in Indiana. The LLC sits under a management company, which sits under a holding entity that has your name on it exactly once, in a document that is not publicly searchable unless someone knows precisely what they are looking for. Nobody is looking. There is a man in your professional orbit. You have encountered him at small business association events, at commercial real estate meetings, at the kind of regional networking gatherings that happen in hotel conference rooms with catered sandwich trays and name tags on lanyards. His name is not important. What is important is what he represents. He drives a vehicle that costs more than most people's annual salary. He talks about his portfolio in the present tense and in the first person and at volume. He drops figures the way other people drop names, casually, frequently, in the direction of whoever appears most useful. When he asked what you did, at the first event where you met, you told him you managed a few property holdings. Operational stuff. Nothing particularly interesting. He nodded in the way people nod when they have already stopped listening and are scanning the room for a better conversation. You noted his dismissal the way you note a useful data point. Because the moment someone underestimates your position, they stop factoring you into their calculations. And the moment they stop factoring you in, you can operate without friction, without scrutiny, without anyone watching the quiet Tuesday morning transactions that compound, year over year, into something that person would not believe if you showed him the document. You have no interest in showing him the document. Your accountant is a man named Raymond. He is 61 years old, has worn the same style of reading glasses for as long as you have known him, and approaches every client engagement with the same clinical precision he would apply to an infrastructure audit. He does not do small talk before the numbers. He does not do congratulations after them. When you sat across from him after the first storage facility acquisition and showed him the projected cash flow model, he looked at it for a long time without speaking. Then he said, "This is boring in the best possible way." You have thought about that sentence many times since. Because boring, in the context of an asset that generates consistent, predictable, recession-resistant cash flow, is not a weakness. Boring means the model does not depend on favorable conditions. Boring means there is no narrative that has to be maintained, no growth story that has to be performed for an audience, no valuation contingent on a market believing something about the future. Boring means it just runs. Month after month. Quarter after quarter. The cleaning company you acquired 3 years ago is boring in exactly this way. 14 commercial contracts. Office buildings. A municipal facility. A private medical practice. 2 school buildings that need overnight cleaning 5 days a week, every week, across the academic calendar and periodically outside it. The previous owner, a woman named Gloria who had built the operation over 28 years, wanted to retire and had no interested family members and no staff ready to absorb ownership. The handover took 4 months. You kept every employee. You kept every contract. You changed the back-end accounting software and introduced a scheduling system that reduced labor overlap by 11%. Annual revenue, $1.3 million. Net margin, thin but immovable. The kind of business that loses clients gradually and replaces them gradually and never once appears in a headline. Raymond calls it the anchor. He is not wrong. There is a woman named Diane who has been your neighbor for 6 years. She waves when she sees your car in the driveway. She brought food when your father passed, and you ate it without ceremony, which is what grief sometimes asks for. She knows you own some rental properties. She knows you are careful with money. She knows you drive a sensible vehicle and that your house has the same gutters it had when you moved in. She does not know about the quarterly summary from Patricia. She does not know about the 7 car washes, or the 4 storage facilities, or the cleaning company, or the billboard ground leases along a freight corridor in Tennessee that generate a combined $26,000 a year in rent from advertising companies who have been paying into long-term contracts since before you even knew the land existed. She does not know that the house you both live near is the least interesting asset you own by a distance. She does not need to know. You have watched over these years what happens to the social architecture of a life when the number becomes visible. You have watched it happen to other people in other contexts, and the pattern is not subtle. Relationships recalibrate around the known quantity. What was simple becomes transactional, not because the people are bad people, but because human cognition reassigns roles when the information changes. You become the person with the resources. Everyone else becomes someone who does or does not have access to those resources. The warmth does not necessarily leave. But the furniture gets rearranged around the number, and the room never quite looks the same after. So the gutters stay as they are. The car stays as it is. Diane waves and you wave back and the information stays where it belongs, in a formatted document in a password-protected folder on a drive that nobody in your neighborhood has a reason to look for. Your brother came to you 14 months ago. He had been in a difficult stretch, the kind that accumulates from several directions at once: work instability, a lease ending badly, medical bills from a procedure that insurance covered poorly. He needed $18,000. You had that amount sitting in a checking account that you monitor approximately once a week. You did not write the check that night. Not because the amount was significant to your balance sheet. You could have transferred it before the end of the phone call and felt nothing in the loss column. That was precisely the problem. When money comes without effort, something important about the transaction is missing. Not for you. For the recipient. Because what $18,000 from you would have purchased in that moment was a temporary resolution that did not require your brother to build any of the skills he needed to make the next 14 months different from the previous ones. You went to see him instead. You sat with him and his numbers for a full afternoon. You identified a payment plan he hadn't known was available through the medical provider. You helped him draft a letter to the lease dispute mediator that resulted in the return of a deposit he had assumed was gone. You connected him with a former colleague who was hiring for a role that matched his background. He found $14,000 of the $18,000 through channels he built himself. You covered the remaining $4,000 as a personal loan with no terms and no pressure. He paid $2,000 of it back 7 months later. You told him to keep the rest. He thanked you the way people thank someone who showed up. That is a different experience from being thanked for writing a check, and not a small difference. You are standing in a hardware store on a Wednesday morning in October. You are looking for a specific type of waterproofing sealant for the exterior drainage channel at the storage facility, because the regional property manager sent you a message with a photo and you want to understand the problem before you send anyone out to address it. You are not the person who needs to be in this hardware store. You have staff for this. You have managers and contractors and service agreements that cover exactly this category of problem. But you were nearby, and the problem is a physical one, and there is something about understanding physical problems in person that no photograph fully replaces. You find the product you need. You take a photo of the label and send it to the property manager with a note. You put your phone back in your pocket. That is when you feel the notification arrive. Not a sound, just the weight of it, the slight vibration that you have trained yourself to check selectively. You pull the phone out. It is Patricia. Not the quarterly summary. A brief message. Total consolidated figure as of this morning's reconciliation crossed 8 figures cleanly. Formal summary attached. No action required. Noted for your records. You stand in the sealant aisle for a moment. The fluorescent overhead fixture has a slight flicker that someone should report to the store manager. A woman to your left is comparing 2 brands of caulking compound. A teenage employee is restocking shelves with the specific lack of urgency that characterizes the Tuesday and Wednesday morning shift in retail. Nobody is looking at you. You open the attachment. The number is there in Patricia's standard 12-point formatting, the same font she has used in every document you have received from her across the past 9 years. The commas are in the right places. You read it twice. You put the phone back in your pocket. You go to the checkout counter and pay for the sealant. This is the part that nobody prepares you for. Not the accumulation, not the discipline, not the architecture of assets that run without you. It is the absolute sameness of the moment the milestone arrives. You had imagined, at some formless and probably inevitable point in the process, that a number like this would carry its own gravity. That the world would be perceptibly different on the other side of it. That there would be something in the quality of the light, or in the way you held your own hands, that would mark the seam between before and after. There is no seam. There is a fluorescent flicker in a hardware store and a notification from an accountant and the same October air in the parking lot that was there when you pulled in. You sit in the car for a few minutes before starting the engine. Not because you need to, but because the information requires some kind of minimal sitting with before you resume the day. You think about the folding chair in Unit 1 of a storage facility in southern Indiana, where Harold used to manage 48 units and a space heater and a ledger from an office supply store. You think about the lock on Unit 17 that cost $18 to replace and was the first physical act you performed as an owner of anything. You think about the $44,000 the first year. The way that number felt large and small at the same time, large because it was real and consistent and structurally sound, small because everyone around you was chasing numbers with more zeros in them and doing it loudly in public. You think about all the Tuesdays. Not the quarterly summaries. The Tuesdays. The maintenance calls and the lease renewals and the vendor contract renegotiations and the hours in Raymond's office going through line items that would bore most people past the point of patience. Those Tuesdays are the actual asset. The document Patricia sent is just a record of what they added up to. You start the engine. On the way back from the storage facility, you pass a self-service laundry on a commercial strip you have driven past perhaps 40 times without stopping to evaluate it. Today you notice the parking lot is consistently occupied for a midweek morning. The sign on the door indicates recent equipment, which suggests the previous operator invested in the business rather than running it down toward a distressed sale. The building sits on a corner lot, which implies a specific lease or ownership structure worth understanding. You do not stop. But you make a mental note in the specific way you have learned to make mental notes, not as ambition, not as greed, not as a restless need for the number to keep growing. Just as the practiced observation of someone who has learned to notice what other people walk past. The note will be there on Thursday when you have time to follow up. Or it won't. The criteria either work or they don't. The building either makes sense when you sit with the numbers or it doesn't. There is no hurry. The existing portfolio is running. The accounts are where they are. The dry cleaner will have your shirts ready by Friday, pressed with extra starch in the collar, and the woman behind the counter will call you hon, and the bell above the door will make its small sound when you leave. Nobody will know. That is not the unfortunate part. That is the whole design. Because the people who perform wealth and the people who build it are rarely the same people. One version needs an audience. The other doesn't. You stop needing one somewhere around the second storage facility, somewhere around the fourth Tuesday of paperwork that nobody photographed or posted or assigned a valuation multiple to. You drive back the same way you came. The car is fine. The accounts are fine. What they have given you is not a number you can spend down but something closer to a pace, a way of moving through ordinary days without friction or performance or the low-grade anxiety of a life that depends on being noticed. It is a Wednesday in October. The drain sealant is in the back seat.